Hello, everyone. I just was told that Mayor Hill is not going to make this meeting. I'm hoping we still have a quorum. We will see. I need 3 people to show up shortly.
Hi, Jill, it's Burgess.
Hi, Burgess.
Is the mayor okay?
Yeah, he apparently scheduled a deposition at the same time.
Okay.
Waiting on one person. You guys will make quorum if we get one more person coming. So,
Oh, yeah, who's gonna run it then? If he's gone as our chair.
we're gonna have to make a decision once we get a quorum.
Who else sits on it?
James Norwood.
The two of us, the mayor and James Norwood?
Yeah,
And
Norwood. He used to be a
Greg's not here?
commissioner.
Greg's not gonna be here?
He's going under cancer treatment.
Oh, wow.
So he might come on virtually, but
Who's Greg?
Greg
Cummings.
Was that the other gentleman? I'm sorry.
No,
Was that the
he's
other
all-
gentleman that was sitting up here with, when I was up here last time?
He might have been here last time. He normally comes
Was he
in.
like prior law enforcement or prior military or something like that?
I think he's military. I think
Yeah.
he was like a former Navy. or
Cause
something.
like I was here, you were here, the mayor was there. There was some gentleman sitting right there.
Well, James Norwood is black and
Oh, yeah, I know
Cummings
James.
is black.
He was a
Yeah.
commissioner for a
yeah,
long time.
so
He and I see each other every morning at Bailey's and. we
Yeah,
give
he
each
might
other
have been here
digs.
that one. In fact, I think he was, because I think he came back behind me and said something.
yeah. Frequently not. It's not right now. So he's doing.
Who?
Cummings.
Oh, Cummings.
Yeah. Okay. Well, not mine. Maybe it's picking, there it is, right here.
Can I do a sound check?
Check.
Yeah, it was.
Who spoke?
Sure, this is Attorney Adam Levinson, and I'm filling in today for Anna and/or Bob from our office.
Great, thank you. This is Jill Kaiser. I'm the pension administrator. We're just getting set up. We'll start the meeting shortly. We now have a quorum.
I hear you loud and clear.
Let's see, looks we got about 3 minutes, don't we?
Yes, sir.
Can you guys hear and see me?
Yes,
Yes.
I can. I can hear you. Yeah, I can see you as well.
Patrick, since I can see you, will we be following the agenda then and having you go before Burgess?
That'll work. That'll work perfect.
All right, thank you.
So everybody, all the presenters are virtual this morning?
Yes.
Okay. This afternoon.
If you would like to ignore the first item on the agenda, the electing chairperson and everything until we have more people here,
Okay,
we can avoid that one for now.
okay. Since it's on the agenda, what we will do is ask for it to be tabled. In that way, it'll show that we did address it and we didn't just look over it and that kind of thing as well.
Six oh two this morning, so we have a text message. I'm sorry, but I'm not. Some stuff, so I didn't respond. So he sends me an email. Read receipt, that's not.
Let's go ahead and call the City of Palatka Police Officers Pension Plan to order. And the first order, let me say welcome to everybody, and looks like everybody is present as well. But also, let's do a roll call.
Scott Nast,
Present.
Present.
James Norwood,
Present.
Greg Cummings,
Present
and Mayor.
virtually.
Mayor Hill is absent.
Okay. The first item A is an election of chairperson and chairperson pro tem and secretary. I'd like to table that until all are present to have that item and table it to a time certain at our next pension meeting if we could. Is there a motion one way or the other?
I second the motion.
It's been moved to table
Yes.
and second by Matt.
By Scott Mass.
Been moved by Scott Mass, second by Matt.
Yes.
Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Next item on the agenda is the approval of minutes. You should have an opportunity to review the minutes. Is there a motion to approve or to reject the minutes?
Motion to approve.
It's been moved by Matt Newcomb,
Second.
second by Scott Mass. Is there any discussion? All in favor?
Aye.
Aye.
All opposed? Motion carries. Next, item 3, Foster Patrick. Item A, the experience study. I think we've been deliberating that for the last two meetings, I know. Experience study discussion. It was tabled from last meeting to a time certain of this meeting. Patrick, do you have anything for us?
Yeah, basically, we're going to go over the valuation report in a minute, and that determines the city's funding requirements. And that's all based on various assumptions, investment returns, salary increases, turnover. And you're supposed to do an experience study about once every 5 years, where we look at your actual experience. And then we look at, well, maybe we should change our assumptions going forward. And then the experience study I'll make recommendations, and then it will show you the impact of those recommendations. And last time you did one was September 19th, 2016. And, the city was doing a salary survey the last time we talked, but I believe that's complete. And so I think you guys could authorize an experience study to be done over the summer. And that way we'll reflect anything that comes of the salary study. And we'll also be able to tell how the investment returns are doing. So that's what I would recommend.
Patrick, is it your firm that would be doing this study?
Yes.
And the last one that was done was in, you said 2017?
2016. So, it's been about 6 years.
And the recent salary survey that was done that the city did, where the changes were made in law enforcement salaries, that would impact this study?
Right. I mean, it like I've said at prior meetings, when we look at these assumptions, they're long-term, but to the extent that the city, made any kind of long-term changes as far as salary increases, then we can reflect that in the study.
Through the chair.
Adam?
Sure. So first of all, let me thank everyone for allowing me to attend remotely on behalf of Anna and others in our office. And I wanted to just volunteer to everybody. And I'm not sure how many years trustees have been on the board, if anyone was here back in 2017, but and I certainly wasn't working with you. But the point I wanted to make is that the gold standard that Patrick is referring to is that you should do or consider doing a experience study every 5 years or so. And the reason being, as Patrick will describe to you, is that evaluation is only as good as the assumptions that are used in the valuation. And I don't want to steal Patrick's thunder, but there is good news baked in. He's working on a lot of good news. And this is potentially, and this may be a question for him about the timing of doing the study now when there's wind behind the sails. So if some are concerned that there may be negative impacts on the city, from the standpoint of some of the good information, and again, that's some of the questions you can ask Patrick, but this is something to be done periodically because ultimately you want to have good assumptions that are solid. And, it is very common for boards, especially the last 2 years or so, to be doing these studies. And that is my 2 cents. So you're not obligated to do it, but it's certainly something that is recommended over time.
Yeah, to the comment about the good experience, we had a big investment return last year. We had a $1.3 million gain, and we're spreading that gain out over a 5-year period. So even if we have a loss this year, the city's costs shouldn't go up as a result of the investment return. So it is a good time from that perspective. Ideally, the city's costs are going to be going down each year. And so if we have to change assumptions, and they cause an increase, well, then they'll be offset some by this favorable experience that we've been having.
Okay, and I guess my mic wasn't on earlier. And as I stated earlier, I was a part of the commission in 2017, but I was not a part of this pension board. I was actually on the city's retirement pension board as well. And we did the study back in 2017. And I guess my question is for you guys that's been here during my absence. Why is it that we have not did the study? Why do we keep tabling this? And we've tabled it over a period of time, seems like.
I know the last time we tabled it was due to the salary study that they were doing until all the new salaries were in place. And those just went into effect here in the last 3-6 months. So my opinion is that that's no longer a valid, that it's probably about time.
Okay, what's the pleasure of the board then?
I motion that we go ahead with the experience study and see where we are from there.
Okay,
I second that.
it's been moved in second that we go ahead with the experience study. Is there any discussion?
Trustees, I don't do the discussion, but I do have a question for Patrick, so the minutes are clear. And Patrick, you may have mentioned it at one of the prior meetings, but just give everyone a feel for what the expense is to do these studies, which are fairly routine.
Patrick, are you on mute?
Looks like his picture's not there, so I'm assuming that he has stepped away for a second. And I think we actually discussed the cost at our last meeting already, and it was not exorbitant. And I know that the cost is going to be split among the 3 different pension. No, this is second. This is the own. Each one will do their own have done their own individual study, right?
That is correct.
$7,500. Okay. Is there any more discussion? All in favor?
Aye.
All opposed? Motion carries. Patrick, is there anything else? Well, he's no longer there. So let's move to Capital City Trust Report. Dwayne?
Okay, good afternoon. Can everybody hear me?
Yes.
Okay, I think she's going to put the report up on the screen. And if you go to the first, scroll on down to the policy review page, Jill, you can, this is as of February 28th. This is the positioning, the police officers' retirement plan. And as has been for some time, we have a overweight to large U.S. companies at the expense of being a little bit underweight to international and underweight to convertible bonds. We are neutral on all the other asset classes because they are approximately valued the same. Fixed income is neutral and cash is neutral as we look for opportunities to buy on dips. So having said that, I just want to remind people that for some time, we've had a bias towards large US growth companies, many of which are technology oriented companies. In fact, about 35% of the stock market is made up of these growth type companies that do quite well in a lot of environments. And so, for instance, Amazon, Microsoft, Google, Apple, just to name a few. So that's been driving the portfolio. The strong US dollar has helped. And I expect going forward that this won't change too much unless Europe and China and Brazil and India start to grow faster than the US. But it would have to be convincing evidence to move out of large US companies. So let's just see if there's any questions on that on this page. If not, we can scroll down to the performance for the fourth quarter, which is the purpose of this meeting, through 12/31. This is the combined equity, which does not include the Sawgrass bonds. And so for the last quarter, which is ending 12/31, the total fund, the combined equity returned 6.08%. The equity portion returned 6. The bonds, which are the high yield bonds, returned 0.36. Real estate, a great return, 14.88. And then, of course, cash is returning next to nothing because the Fed has rates low. And then for the latest year, you see the year to date and the 1 year are the same number, 18.69 up top there. That's an outstanding number because equities did such a good job, 19.55, which includes the convertible bonds. Taxable bonds, which are the high yield, returned 3.25, and real estate returned 39%. And as a lot of you know, that was caused by the federal government stimulating the economy with plenty of liquidity and low interest rates, which when you juice the economy, you also sort of juice the stock market. And that, along with the reopening of the economy and pent-up demand and low rates, it all combined to make a perfect storm, resulting in terrific equity returns. Each of the last 3 years, the equity part has returned 21% a year. Each of the last 5 years, 13.9. And since inception of the data that I have, 6.37 per year. So it's been good. And I mean, even the actuarial study will tell you, there's a little bit extra. So it's been good. So the fourth quarter was good. Any questions on the fourth quarter? If not, we can scroll down to the next page, which is the latest data I had when I printed this report through January. And you can see year to date, the equity part is down 5.75 because, as a lot of you know, that in January, a correction began due to a lot of reasons. Stocks got a little bit expensive. Interest rates were going up. And by the way, stocks do not like rising interest rates at all, especially technology stocks. So technology retreated 20% into a bear market. The broad stock market, however, touched correction territory of about -11 and then came back from there. So we did touch on a correction, which has since gotten a lot better. And that's sort of the nature of the beast. Once or twice a year, the stock market will correct itself because it gets a little bit bloated. And that's what has happened. And then on top of that, you have inflation and some other bad news like the Ukraine conflict, which caused oil prices to jump. So that exacerbated the problem on into February and part of March. And fiscal year to date, I've estimated the combined equity return to be positive 0.5%. After all this, at fiscal year to date, September 30 till now, I'm estimating 0.5. Of course, the bonds are probably in negative territory. So there's hope. There's a silver lining that maybe we'll reach 7.7 this year. I don't know, but certainly I don't think it's going to be negative. Any questions for me?
So with the volatility and the kind of downturn that you're indicating that's happened in the first part of the year, is the recommendation basically to stay the course and take the long view? Over?
Yes, because you have a long time horizon, you can afford to ride out the bumps and buy the dips, which is what I'm trying to do. In fact, a couple times in January and February, I put about 200,000 to work in equities. And I think by the time we get to the midsummer, that'll be a good decision. So yeah, I don't see any reason to take back into cash or run for the hills. This is a strategic portfolio, which means it's based on a long-term research done by Burgess and his firm.
Okay, I know the actuarial talked about smoothing before, and I think I understand it. So I feel comfortable with that long-term view, and we'll smooth out some of the bumps with the past 3 or 4 good years, even if this is a bad year on us. Over.
Okay.
Yeah,
Any questions? Go ahead. Any questions? Jill, can you scroll down a little bit more? The rest of the report is the asset allocation as of March 1st. It's just for informational purposes, you're 57% in equity and 32% in fixed income. So it's a moderate growth portfolio. It's not aggressive. And it's done well over time because it's sort of in a sweet spot. Historically speaking, a 60-40 portfolio tends to do really well, and that's about where you are. If you scroll down a little bit more, Jill, you'll see the mutual funds that we use, some Fidelity, mid-cap, small cap, and some Vanguard low-fee funds. There's an active American funds, Euro Pacific, that's actively managing international. There's a convertible securities fund, convertible bonds. And then there's the Sawgrass. Then there's the high yield bonds by Vanguard. That concludes my comments. Any questions?
Okay.
This is
Any
Attorney.
questions from the board?
Yes, yes, sir.
So this may be for the investment consultant for Burgess, but I noticed that, and it is what it is, because mutual funds, you don't have direct control over the holdings, but the American fund, which is an international, the Europac mutual fund, it does have some, or I should say did have some Russia exposure. And it's a very common fund to see in a lot of the portfolios, but you want to speak to that real quick, the impact of any Russian holdings in that particular mutual fund.
Are you directing this to Burgess or to Dwayne?
So whoever wants to take that question.
Well, I have, if you give me a minute, I can actually look up the a distribution of the holdings. Do you have in front of you, Adam, the holdings of this fund?
I don't have it at the moment, but I'm aware that there was around a 1% allocation, and that was before the Ukraine invasion. So I suspect that that's a lot lower. In fact, we know for a fact it's a lot lower now. But again, that's diversification.
Dwayne can look on his computer right now on Morningstar and actually get a breakdown of all of the holdings in the portfolio in the fund as of probably 12/31. I'm looking at the supplement in the back of the books that all of you have. In my book, it's about 5 pages from the, it says it's page 6 of 30 in the very back. But most of the emerging market holdings in this portfolio at Euro Pacific are in China, Taiwan, Hong Kong, Mexico, India, very, very de minimis amount of holdings in Russia. And this will be a very dynamic situation. I can't tell you what it is today, but it's something we can certainly address in more detail later.
I don't have anything in front of me, but I do know historically they will use emerging markets countries, which are Brazil, Russia, India, and China. But I don't know that they've made any changes off the top of my head.
Any more discussion? Is there a motion to accept the Capital Trust report?
Motion to accept the Capital Trust report as presented. Second.
It's been moved and second that we accept the Capital City Trust report. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Burgess?
Yes. Can everyone hear me okay?
Yes, sir.
Good afternoon. I'd like to take you please to, you got the handout and Jill can scroll down to page 17 in the, she's going to change files here. So she's going to go into the front of my report. While she's doing that, if you go to page 17, you can see where the crosshairs are, the intersection of the returns and risk or standard deviation for both the 5 and 3 year periods. And what I really wanted you to see is that the strategic model, which was developed in order to achieve an 8% long-term return, that hasn't changed. But the experience, the blue dot, has really been in line with the strategic model. Jill, can you change the screen?
I'm sorry, Burgess, I had it up and apparently it's disappeared. I'm trying to get.
That's okay. Everyone has a book, so we can go through the book. So that's a favorable experience that you can see on page 17. Then on page 18, I wanted you to get a sense of, there you are, 18. Going back to 2005, the worst fiscal year period going back to 2005 was the 2008 period, believe it or not. And that was the depths of, actually the bottom of the recession was, or the, I should say the fallout of the mortgage fiasco was in April 2009. So even though 2009 is almost zero at 0.71, half of that fiscal year was very negative. So from April 1st, 2009 through September 30, 2009, the market was up enough to pretty much wipe out what was lost in the prior 6 months. But going from right to left, you can see that the preponderance of experience has been quite favorable. On the very left-hand side, you see 4.59%, I believe. And that was your first fiscal quarter, the year you're now. And I would say we're probably, most of that has probably been wiped away because of the downturn this quarter so far. Although as Dwayne indicated, results are getting better. The S&P 500, which you participate in, was down about 12 since January 1 at one point. Now it's up to about -6. So it has already recovered half of what it lost. The other chart I wanted to show you, because usually I skip these, is on page 19. And yeah, if you look at the upper, the first illustrations at the top with the 4 colors, those zones indicate quartiles. The top quartile is sort of a light blue and the bottom quartile is red. And you can see that over rolling 5-year periods, the blue, which represents your experience, has been above the model pretty much the whole time, except for one period or two earlier. It also indicates that 75%, 35% of the time, that's 10 plus 25, results have been at the median or better. And given your allocation, I think that's quite impressive. And then if you look at the past 3 years, the next one, the rankings have been they've been in between the top 5th and top 25th 15% of the time. And between top quartile and the median 40% of the time. If you look at the graph in the upper right-hand corner, you can see the little blip there between 1219 and 620. That was the fallout from the COVID, the beginnings of COVID discussions in, around February of 2020. You could see that blip. And to everybody's surprise, the market recovered swiftly. And you can see how the line continues, the slope continues up towards the northeast. We're having another little blip here because of what's happening in Europe. And we'll see how long that takes to correct itself. As Patrick pointed out, the nice return you had in 2021 fiscal year, which you can see in your report on page, we were just looking at it, on page 18, 19%. He's gonna spread out the gains of that over a 5-year period. Patrick, you still with us? Maybe he's not, maybe he turned off his mic. But anyway, that's what he was referring to, that big gain that year, last year.
Burgess,
Yeah.
Can you hear me?
Yeah. I heard you making iced tea in the background. You okay?
No, I'm fine. Can you see me or no? You probably can't see me.
No,
All kinds of-
I don't see you, but it's okay. I know what you look like.
Right,
I can-
right.
I can hear you.
That's what matters the most. Yeah, we're gonna spread it out over 5 years. And we can talk about that in my report too.
Okay. I just wanted to show them, give them another insight as to what we're talking about. Okay, let's go back to the beginning of my report. I'll kind of move swiftly now, page 1. This is something that might be of interest to you, but really, as Dwayne suggested, we are seeing a rise in interest rates now. These 3 graphs represent different time periods. The one at the top was 2013, December. The one at the bottom was a couple of years ago, and the one in the middle is December, just recently, 2021. The 10-year in the middle graph is illustrated at 1.52. That 10-year now, I think, is around 2.2, 2.3%. So it is now shifted up and moving up towards the upper graph that you see here. This snapshot is about, 8 years old. So it's moving back towards a 2013 type of a yield curve. I should point out that what's different between today and 2013 is that we have an economy growing at about 3 times the normal rate. The economy usually grows around 2% a year. We're growing at about 7% a year. And with that high level of growth, there's a lot of inflation. And with inflation, companies are able to do what they haven't done in a long time, that is raise prices, whether it be lumber or faucets or windows or car prices, or meat. Everything across the board is going up in price, and companies translate those higher prices into higher earnings. So this environment is actually not terribly bad for stocks. It's putting pressure on bonds. It's pushing down bond prices. But in the near term, this environment enables public companies to raise prices, thereby raising earnings. Go to page 4. Look at the summary remarks. This model is a 65-35. There are other plans that run more aggressive equity models, closer to 72-75%. This allocation is ideal for the kind of environment we're in right now. You have a lot of passive investments, that is index funds, and that's been the key driver frankly, in your performance and cost management. Been able to keep your costs down right in the 0.3 to 0.4% per year range, which is at least half of what your peers are paying in this with this type of plan size. Total results for the quarter, I don't want to repeat too much of what was said, but 622,000 or 4.5% net, impressive. Almost the top third amongst your peer groups. Talked about the REITs. And then if you go to the next one, the 1 year period, the leader once again were the REITs at 40%. And I think this surprised everybody. Why did real estate, commercial real estate, and this is represented by companies like Prologis, which makes warehouses, self-storage, apartment complex companies, adult assisted living facilities. The replacement costs have gone up so fast because of the supply chain disruption and the labor shortages that this is now being reflected in the value of the underlying companies or properties that are in the REIT index that you own. Cohen and Steers rounded out the third position for the year at 7.7. I looked at Cohen and Steers returns this year to date, and they're flat. They're zero, and that's quite impressive when you think the broader equity markets are down anywhere between -5 and -16%. So the infrastructure is doing exactly what it was designed to do, protect you in this type of environment. Actually, I was talking about the first quarter, Cohen and Steers, if you all were listening. Sorry about that. 7.7%. 10-year average is important to note here. The plan earned $10 million over the last 10 years, averaging 9.6% net of fees. And our mission was to make 8% net. So congratulations to all of you who have been a part of this program. Any questions so far? I'm finished if you want me to finish. You can go to page 7. Wrap it up here if you want. The dollars 10 years ago, the retirement plan was worth 7.7 million, and you can see there were withdrawals over that or negative contributions during that time of about 3.5 million. That's related to the net impact of the 185 chapter money coming in, payroll money coming in, city contributions coming in, then minus retirement expenses and administrative professional fees. And that's where the minus 3.5 million comes from. But the good news is that the plan earned nearly 3 times the net outflows. I think Capital Cities has done a good job with your program, frankly. And with that, I'm happy to pause and see if there are any questions.
Burgess,
Yes, sir.
this is Dwayne. I just got an email from the American Funds representative, and he says that Russia represents 0.03% of the American Funds Euro-Pacific Fund.
0.03%. So since international represents about, maybe 12%, you're talking about another decimal point. It's very small.
So I will forward this to you, to your email
Okay.
in your office.
It's good to know that. I'm sure they're going to be under pressure from other institutions to address this, since it's so de minimis in terms of the weighting. I'm confident they're probably going to get rid of what's there. It's probably a fertilizer company and maybe some energy company. That's probably it. Thank you for the update.
Okay.
I'm gonna have a meeting on Friday with the guys, the team in Orlando, and this will be an item of discussion, and I'm happy to get an email out to Jill with more clarification. Any other questions?
I have a question, Burgess.
Yeah.
Nesta and I, at the last meeting, were hoping that the police board would approve the investment policy for our purposes, our internal purposes. We get audited and the auditors like to see that the policy has been reaffirmed.
You mean the expected return?
No, just the signed
Allocation.
policy. If we could reaffirm it, we don't have to re-sign it, but if we could say that it's been reaffirmed by the board, that would help us.
Okay, well, since the investment policy is in effect and has not been revised, then I see no reason why the board can't make a state for the record that the existing policy remains in effect.
Right.
So Greg Cummings here, and maybe Jill help me out here. During that last meeting, that we just do a sidebar or something afterwards to make minor changes to the policy? Or was that another document? Over?
There was some discussion about putting caps or ranges on different categories, but that was never presented in full or voted on.
Burgess was supposed to go back and actually take a look at putting those ranges on. That way it'll be a part of their policy to where.
Yeah, it's coming back to me now. Dwayne and I actually worked on that together. And I'm remote and I can't get into my office. There's a technical problem and I can't pull that document and present it to you. But what I can do tomorrow is get it sent over to Jill. Do you remember, Dwayne, you and I worked on that together. Remember, right? Actually, the day after the last meeting.
Right. Yeah, I sent you some ranges, which tended to be about ±5 or ±2.
Yeah.
And so, yeah, that's something we need to do. But I would just say, as the policy stands today, if they reaffirmed it, that would be sufficient.
Trustees, this is Attorney Levinson, and I would have no objection to reaffirming the policy as it stands today. It's in effect and we can affirm it. But let's put on the agenda for the next meeting any tweaks that Burgess or Dwayne want to make.
I guess
Good.
the only issue that I would have with reaffirming the policy today is the policy is not in front of us. I don't know what the policy, and I'm a new board member, of course. I don't know what's in the policy. And I'm just uncomfortable voting on it just because I just don't know.
This is Burgess. The policy that's in effect now, Jill has a copy of it somewhere. And it was ratified in December of 2017.
But that was after my time.
Okay. That policy went into effect January 1, 2018. So it really is, I can certainly have my office send an electronic version of this. She should have it. If she doesn't, we'll make sure she has it and a copy can be presented to all of you. But back to Commissioner Norwood's request from the last meeting, we will, we're happy to finalize a table that Dwayne and I worked on, which established reasonable ranges for each of these asset classes. And in my report on page 8, you can actually see where, if you can take them to page 8, Jill, where it says percent target that column that starts with 32 and then 5 and all the way down, that comes straight out of the investment policy, Commissioner Norwood. So that's exactly what we're referring to. And really from there to expand that target to have a little bit of wiggle room that's acceptable to the board. And I'll get that to you prior to the next meeting.
Okay. Let's see,
Apologize.
Can us doing this wait until the next meeting, or is this going to be something that puts Capital City in a bind with the audit that they're looking at having done?
Actually, what we're dealing with right now is less restrictive because there's no limit on the ranges. The only limit he has is the total equity allocation can't exceed 70%. But otherwise, I think that this is perfectly fine from an audit standpoint. I think what the auditor is just trying to make sure that the board's investment policy is consistent with what Capital Cities is doing, and vice versa. And really, it's the upper range of the equity limit is what he has to be very. That's the only thing he's got to worry about right now.
Because if you don't have a policy in place, I guess that's the only way you can actually audit. You got to have a policy in place to make sure that the ranges that you're in is, you're complying with what you said you would do in the policy. That's what auditors actually normally look at. Whatever the policy says and versus what you're actually doing, it tells you whether you're in compliance or out of compliance.
But I guess my question is can we table this until the next meeting so that we can all, I'm a new member of this board as of the last meeting. Commissioner Norwood's been a city commissioner with us in the past and has been on the other retirement board, but not this one. So is this something that we can wait on until the next meeting? Or is it something that we have to do right now to make it to where Capital City's not in a bind with their audit? I don't know if I'm making any sense for you guys.
Yeah, I think I understand what you're saying. It's my opinion that you can ratify the current investment policy as council recommended. And that I think that's all that Dwayne is looking for. So that then satisfies the auditor's request. Is that right, Dwayne?
Right, that it's current.
And then I guess what will happen at the next meeting concerning investment policy as well?
That the next meeting, a new draft will be passed out, which will establish within each category, equities, fixed income, and so forth, ranges. And those ranges then would have to be followed by Capital Cities.
Okay.
Now that'll take care of that. I think the two are unrelated. For today's the request, I think from Dwayne, I think that's been satisfied. I understand the way it's been discussed so far.
And the page 8, actual versus target assessment allocation, that's basically what the policy actually looks like now.
That's correct.
Is it possible to bring the Capital City report back up? It'll probably match the same thing, but the way Dwayne shows it kind of on that front page, I think from my perspective, being on the board, I guess a little over 3 years now, I would affirm that we're operating under the policy that was signed and officially started on 1 January 2018. And maybe a caveat to that motion would include that since it is about 4 years old or a little older, that we are re-looking it for modifications. If that would suffice for the audit, I think I would be willing to do that without the actual copy in front. That there's one page, Dwayne, that you show of allocation, the one that shows overweight, underweight, neutral. What page was that?
Go up, Jill. Keep going.
And while you're scrolling, I'm just
There
going
it
to
is.
point out,
That's on a different date than Burgess's page 8. Mine was
No.
done on February 28th.
No, but the policy percentages is, I think.
Oh, yeah, yeah, the percentages
Correct.
are directly from the policy.
I guess this is to the attorney. You know, just, I guess I'm gonna ask this question now because I will forget, I'm getting old now. How often should we ratify the policy? What's the
So,
recommendation?
I'm going to give you a roundabout answer, which is unless you've changed the policy and you haven't, it remains in effect, which is why I have no problem with the board affirming that that's your policy because you haven't changed it since 2018. And then I think that the motion that was put on the table to say as part of the motion that you're going to be looking at it at the next meeting is fine as a little addendum. But the answer is some boards have used the same policy for a decade. Other boards change it from time to time, and it's a function of several things. It's a function of, are you adding new managers? Are you adding new asset classes? Are you adding new consultants, right? Because a new consultant sometimes will want to make big changes. So it's all over the map on how often you see it change. So that's why I can't give you a direct answer about how often the policies change. Burgess can give you a better idea. It's also a function of asset growth. It's a function of, lots of variables, what's going on in the markets. But because you've had good markets for the last decade, it doesn't surprise me you haven't really made that many changes or any changes in the last 4 years. So that would be my quick answer.
Okay.
Yeah, so we would, at each meeting, board members, we would get to see this presentation with the overweights, underweights, and we've had limited conversation on, is that okay? And it was based on market conditions. I think Commissioner Norwood and as a member brought in a good point in the last meeting or before that maybe we should have some upper limits or lower limits just to ensure that we keep Capital City out of trouble with the board, so to speak. But Dwayne has briefed us each and every time on where we were overweight and why. And it was logical and agreed with the market conditions at that time. Over.
What's the pleasure of the board?
I motion that we go ahead and affirm the policy as it is now. And if we need to make any changes, we can present those at the next meeting.
Is there a second?
Second.
Is there any discussion? All in favor?
Aye.
All opposed? Motion carries.
Thank you.
Can we also get a motion to accept Burgess's report?
I motion to accept Burgess' report as presented.
Second.
Been moved and second that we accept Burgess Chambers Association report. Is there any discussion? All in favor?
Aye.
Aye.
All opposed? Motion carries. Pardon me? Oh, I'm sorry.
Hey, don't apologize. So it's hard to see with all the screens. So something for Burgess to think out loud about, and I'm not sure if you can hear, but some of the boards from time to time will ask the consultant to include the full investment policy, which sometimes Burgess is maybe an 8-page document in his report. So it kills pages, it kills trees, but often if it's being done electronically, it doesn't kill that many trees. So that's just something for Burgess to give some thought to while you sort of get the information from the targets and from the information in his report. It may not be a bad idea to include the full copy of the investment policy at the back of his book, because I know a lot of boards will do that from time to time. Burgess?
Well, it just depends on what you want to do. If you want it in the report permanently, that can be done. If that's what the board wants. Sometimes, yeah, I'm happy to do that.
I don't see where it would hurt us. I think it would just give us more information and probably dispel some of the questions that we may have as well.
Very good. We'll take care of that.
And I guess while we're still in all these reports, is there a reason that we don't get the get the reports in color? It makes for a much easier read. I know it looks like we are copying from one report and giving it to each board members. And when I look up on the screen, and I'm at home, when I'm at home and I get it email, I don't get the color version. And even here at the desk, I'm not getting the color version neither, for whatever reason. And we used to get all, the report. The presenters normally would give us the reports, and it will all look alike. Is there a reason that we are?
Simply a cost savings. It costs us 7 cents a page to print in color, and I print all these documents for 10 users, the 5 of the board, and then whoever shows up. So when I'm printing out 60 pages for Burgess's report and 50 pages for the valuation report, it starts to get pretty costly, and we're trying to keep our costs down. Those that are emailed to me, then those go out as scanned copies. But if they send them to me as an email, if I get it in print, then it's simply a cost savings.
Well, this is Burgess. My office is happy to send you, Jill, all 3 boards, the published reports in color.
Yes, you do. And those I include in the.
Okay, so I'm off the hook on that one.
Yes.
Okay.
But you just don't send it for each board. We just send one copy and then you copy for each one of us. Okay.
Well,
I think it depends on how she gets them in. The email that I had from Jill shows the capital city as well as Burgess's report in color. But I've got it on my computer right in front of me. If I were there in person, I would be in the same boat.
Yes,
as you
it's simply
black
the
and white.
printed copies that
Okay.
you people are seeing at being here.
Okay.
I print. If we can get away with not printing copies and simply watch the screens, then it'd be even a bigger cost savings.
Well, I guess I'll just like to have the information prior to the meeting wherein I can actually have an opportunity to look at what I'm actually about to deliberate over. So I guess we'll continue with the current process until we deem it that we need to do something different. So, Burgess, you got anything else for us?
no, sir, I just want to clarify with Jill. Is my office providing you with more than one color copy?
They are, unfortunately, this meeting, the people who have begun now cleaning the offices took everything that was on. the
Okay,
floor. I
okay.
saw-
That's what I thought, because, yeah, normally all of you who were present will get a color report in color from our office as well as Cap City's. So is that correct, Joe?
Yeah, at the meeting. If
That's
they
right.
pick it up in advance of the meeting, no, then I print them out in paper.
But wait a second.
Color.
In advance of the meeting,
I
Meaning
send them out. I send them out to all
electronic?
the board members 2 weeks before.
Oh,
Then, and then if they want me to print out copies, I print them out not in color. So they get them in color in an email 2 weeks before. They get them from you bound the day of. But if they want them in that interim period, printed, then I print. them.
I see what you mean. Okay. Okay.
Commissioner, are these things done electronically?
Okay.
All the way around?
They are sent out
No,
electronically.
I know,
but-
that's what I'm saying. I'm just asking, is it something that we can just start doing from here on out? If they're in color electronically, couldn't we just
the question then comes up this, does everybody have an electronic device that they can actually pull it up on in the meetings? Because I know the city doesn't provide us with iPads.
No, they don't. The only way to see them is up when you're here.
Mhm. That's the question now then. If, we just want to go to just color, is, how do we protect the integrity? I guess if you're sending it out anyway, we don't have to actually protect the integrity of it. It's actually public information anyway. Okay. Well, I think that we could probably have that discussion when all the board members are present and that kind of thing, and we can kind of get the feeling on what everybody desires are, if we would. Let's see, I think the pension attorney he's filling in for Miss Ann Parrish, I believe.
That's right, trustees, but more important than the attorney's report, and I have a very brief report for you. I know Patrick wants to circle back and go through the valuation because there's good news in the valuation and you have to approve it because it has to be sent to Tallahassee. It then gets used in the city's CAFR, it gets used in city budgeting. So if we still have a little bit of time, it's more important to go through the valuation if Patrick is back. I know Patrick was having some internet issues. Is your Wi-Fi back, Patrick?
Yes. Can you guys hear me okay?
Loud and clear.
Okay. When I dropped off, you were in the middle of discussing whether or not to proceed with the experience study. Did the board make a decision on that, or?
Yes, we did. We
Did you decide
voted in the affirmative.
Okay, great. Well, then if we want to go over the valuation report, you should have color copies in front of you, right?
Yes, we got your report in front of us.
Okay.
Here, you don't want any red.
So unless you're talking about the liabilities. Page 6, every year we look at the assets in the plan and then we project out all the future retirement benefits and we determine an appropriate funding requirement for the next year. And the costs went up slightly in this report, but that's a little bit deceiving because we actually improved benefits because the way that has always worked at the city of Palatka is that all the employees get the 2.75 benefit accrual rate or 2.5% benefit accrual rate. The general employees, the police and the fire. And then every year we look at the state monies and we say, okay, how much of an extra multiplier can these state monies provide for the employees of the police and of the fire? And so if you go to page 8, now currently you guys are at a 3.1% benefit accrual rate, which is 2.5% from the city and 0.6% from the Chapter 185 monies. But what goes into the calculation is we basically, since I started here, which has been like over 20 years, we accumulate those state monies that we get every year with interest. Whatever the plan earns, they're in the plan and that's what they earn. And then we look at the extra benefits paid, this extra 0.6 multiplier that's we've paid to all the retirees. And then we say, okay, we have this much extra state monies. How much can we pay going forward? And that's how the calculation works. So because you guys had such a strong return in fiscal 2021, we were able to increase that benefit accrual rate. And we always do that 1 year ahead also, just like we do the valuation report. So effective 10/1/2022, that multiplier is going to go from 3.1% to 3.15%. And so, that increase in the multiplier increases the funding requirements. But it's really come from accumulated state monies with interest. Does everybody understand or have any questions about how that works? Okay, so then if you go to, when we talk about the investments that we've talked about a couple of times today, that's on page 31. So towards the top there, it says we had a market value at the beginning of the year of 11,860,000. And then Burgess had mentioned before that you've had more benefit payments go out and expenses than you had contributions come in. And so on average for the year, we probably had about $11.6 million in the plan. And we have a 7.5% assumption. That's what we're expecting to earn. And so we expected to earn $873,000 on that money. And in the end, we actually earned $2,271,000 during fiscal 2021. It was a knockout year. And so we beat the assumption there by $1.39 million, $1,397,000. And if you scroll up just a touch, Jill, you know, basically we're going to spread that gain out over a 5-year period. So we're really only going to recognize $279,000 each year for the next 5 years. So right now we basically have a cushion in this 2021 valuation of $1,118,000. That'll offset any losses that we have relative to our assumption. So for example, if we got a 0% return this fiscal year, you know, that would be a loss of 7.5%, you know, compared to our assumption. Well, that might be a $900,000 loss. But we'll recognize 1/5 of that $900,000 loss each year. And we're still recognizing 1/5 of that $1.4 million gain we had this year. So all told, the city's costs are not going to increase next year, even if we have a loss this year on the investments. Does anybody have any questions about how that 5-year smoothing works? All right, so that was the investment side was positive. Then if you go to page 38, this is the turnover. So at the beginning of the year, you had 1 person in the drop and you had 27 non-drop police officers. And you had 1 person terminate vested, and you had 1 person terminate and they were not vested, but they just hadn't yet received a refund. So they're entitled to that refund of contributions. And then you had 2 members take refunds of contributions. And then you had 1 member enter the drop, and then you hired 4 new police officers. So you went from 27 at the beginning of the year to 26 at the end of the year. That turnover was a little more than we expect based on our current assumptions. We expect about 3 people to terminate each year, non-retirement, and you had 4. So that was a little bit of an actuarial gain to the plan. At the bottom of the page, it's a nice thing. You know, you had 23 retirees at the beginning of the year, and they all lived a happy year. And so we had a loss on mortality from an actuarial standpoint because everybody drew benefits for 1 more year. So then, since you're already towards the back of the report, we can look at one of the best pages in the report, and that's on page 47. So we've talked about the smoothing of the assets for the funding purposes. so that the city's costs don't go way up and way down each year. But for accounting, for determining the net pension liability there, we do not smooth the assets. And so at the beginning of the year, as of 9/30/2020, the city had to book a liability of 1,625,000 for the pension plan. And as of 9/30/2021, it's down to 536,000. So there was a huge improvement there in the net pension liability that the city has to put on the balance sheet. Now, mind you, if we have a bad year this year, then that'll probably jump back up again. You know, we don't use the smoothing, so it's more volatile. But this year that really helped us because we got to use all of that 20+% return.
Patrick Burgess here, just for the benefit of the board members and guests. GASB requires the gain to be captured in 1 year, gain or loss, right?
Correct.
So from the city's reporting perspective, they use the GASB numbers, right?
That's correct. Correct. When they show their financial statements, you know, their CAFR, they use this information.
Okay. Do all of you understand the difference? What we're talking about?
No.
Well,
Okay,
basically,
let's clarify it slowly. Thank you.
So basically, you know, the city has their financial statements to say how well the city is doing, how much cash they have on hand and all that. So they do a comprehensive annual financial report. And that way anybody can look at the city's books and say, oh, here's how well they're doing. Here's how much cash they have. Here's how much liabilities they have. And so that's the governmental accounting standard. That's what this is, GASB 67 and 68. And so at the top of the page is the total pension liability. And that basically says, what's the value of the benefits in the plan that everybody's earned? And it actually even takes into account future salary increases when it does that calculation. But there's a total liability for the pension plan. And then at the bottom of the page, it says what's our asset value? How much money do we have in the plan? And that went from 11.8 million last year to 13.7 million this year. So even with the net outflow that Burgess talked about earlier, there was a huge increase in the assets in the plan. And the liabilities grew some also. They always grow a little bit each year. But when you take the difference then, if you look at the assets of 13.7 million and compare that to the liabilities of 14.2 million, they would say, okay, we have an unfunded liability in the pension plan of 536,000. Last year, that unfunded liability in the pension plan was 1,625,000. So does everybody kind of see how it works on the accounting side for the plan?
Yes.
What's the funding
So-
ratio under GASB?
So that ratio, at what point is there a concern that the city will have to cough up that difference? This is where I guess some plan.
That's a perfect question to lead into the other side of the equation. So this was the accounting of the plan, right? But then every year you have me, the actuary, do a valuation of the plan and we do a funding valuation. And that funding valuation says, how much should the city contribute so that we have enough money to pay everybody's retirement benefits once they retire? And that's the front half of this valuation report that we're looking at. And so in that valuation, we can use smoothing techniques with the assets. So in that portion, when we determine, you know, you said, when does the city have to worry about putting in extra money? Well, every year we look at the assets and the liabilities and we determine how much money the city should put in. And for that purpose, we can smooth out those asset gains or losses because we're not going to pay everybody's benefit this year. You know, most of our liabilities are going to be funded in the future. So if we can defer some of those investment gains we had this year and spread them out. And that's what we talked about on the previous page about the 5-year smoothing.
So great points. And I think during last year's training, that was highlighted. Let's say we were in the black and had more money and the city's contribution theoretically could have been zero. We wouldn't recommend that, I wouldn't think, but we wouldn't recommend exorbitant increases just because there could be bad years in the future. So taking the long-term view, as I understand it, those incremental changes with smoothing are the way to go. All right.
Exactly. That was a perfect way to say it. You know, we have a great return this year. And, you know, if we weren't smoothing, we could say, okay, now city, you can put in a lot less because we had a great return. But then next year, if we have a bad return, we might tell the city, oh, now you have to cough up more. You got to increase your contribution. So we like that slow incremental approach that you mentioned. And Burgess asked what the funded ratio there is. And so if you look at the market value of assets compared to the accrued liability, we went from 87.9% funded ratio last year to 96.2% this year. And plans try to be in the 80 to 100% range. So you guys are very healthy as far as your current funded ratio. So then if you want to go back, Jill, to page 18. So we talked about that net pension liability in the GASB, the accounting. Well, the unfunded actuarial accrued liability is the term we use in the funding valuation. And that uses the 5-year smoothing. So last year, our unfunded actuarial accrued liability was $2,013,000. And we make a payment each year to pay that down. So we expected it to be $1,985,000 as of 10/1/2021. And in the end, it was only $1,813,000. So we had a nice little improvement there in our unfunded actuarial accrued liability. And you can see in the middle of the page, we had an actuarial gain, just our regular experience was a gain of $399,000. And $279,000 of it was the investment return. Remember, you had like a $1.4 million gain, but we recognized 1/5 of that, and that's $279,000. Salary increases, you know, each individual, we look at their individual salary increases compared to what we expected, and that gave us an actuarial gain of $139,000. And then turnover, active decrements is really the turnover, and that was a gain of $121,000. And then remember I said nobody passed away, so that's an actuarial loss of $53,000. So all told, we had a nice actuarial gain during the year. And then we made that benefit change, and that increases the liabilities by $228,000. And that's how you come up with the $1,815,000 at the end of the year. And so if you go to the very next page, our funded ratio there, using the smoothing, is 87.4% as of 2021. And you can see you've been very healthy. It goes up and down a little bit each year. But another thing to point out is if you go back to 2010, you were using an 8% investment return assumption. And from 2016 to 2020, you guys reduced it 0.1% each year until you got to 7.5%. So if we were using an 8% assumption, that funded ratio in 2021 would actually be higher, because things look better if you think you're going to earn 8% rather than if you think you're going to earn 7.5%. Then if you go back to page 13. So the top of page 13 is the normal cost, and that's just the cost of each member accruing benefits one more year. And that stays pretty stable. It was 16% of payroll last year. It would have been 16.1% of payroll. And then with the benefit change, it goes to 16.4% of payroll. Administrative expenses were pretty flat, 2.4% of payroll last year to 2.6% of payroll this year. And then that third line is the payment required to amortize the unfunded. Well, that was 16.2% of payroll last year. It would have went down to 14.6% of payroll. But then with the benefit change, it goes back up to 16.1. So that's where your total required contribution went from 34.6% of payroll last year to 35.1% of payroll this year. And those are the numbers we talked about at the beginning of the presentation. So those were kind of the highlights that I wanted to go over, but I'd be happy to answer any questions anyone has.
Any questions? Seems to be no questions. I guess since you went back over the entire report, basically, let's get a motion to accept it in that way.
Trustees. So this is Levinson. I don't want to interfere with a motion, but I did want to ask Patrick real quick about more good news. So he talked to us about the actuarial gains. He talked to us about the the investment returns, which are of course very positive. But I wanted, if you could, Patrick, to go to page 28, which is the growth of the state money. And this is really for some of the newer trustees, just to give them a flavor for how that money has operated the last couple of years. So one of the sources of funding for this plan, as everybody knows, is not just the investment earnings and not just the city contribution and not just the member contribution, but the money we get from Tallahassee. It's primarily based upon car insurance, and there's some other forms of insurance, auto theft and plate glass, et cetera. But if you look at the very bottom there, you can see this past year, 2021, and it's always a year behind, the amount of money you got from Tallahassee increased by around 13%. And we have a list of our plans all across the state, and about 30 of our plans were down for the year. And you guys and gals had a wonderful increase this past year. So Patrick, if you want to talk to us real quickly about the premium tax money, and it's nice to see, because on this page, you can see that you track the history of that premium tax, which allows us to purchase that higher multiplier all the way back to 1998. So just any comments on that, and then I think there's going to be a motion to approve.
Yeah, I mean, the statement is going up. In this case, normally, it's a good thing, but in this case, it really just helps the members of the plan, because those state monies, we keep track of them, and they earn earnings, and then they get used to provide additional multiplier for the members. And so that works out to be a wonderful thing. And you can see that it actually started to go down a little bit. If you go from 2008 down to 2013, but since 2013, there's been a nice steady improvement, and that just goes to help. But another point, Adam, is that if you go to page 9, when we show the funding requirements, we're showing the requirements for 2022 and 2023. And, we're basically assuming the state money is going to be the same as it was this year. Well, last year, the state money only represented 5.2% of payroll, and this year it represents 6% of payroll. So that did reduce the bottom line city requirement by 0.8% of payroll this year, because we had that nice improvement in the state monies. So yes, that is definitely a good news piece of this report. Does that answer your question?
So that drives another comment. Thanks, Adam. Thanks, Patrick, for bringing that up. The state money is incumbent on having all of our city reports in the right format and in on time. Is that a fair statement?
Yeah, there's a report that you have to do each year. We call it the state report or the annual report. And that has to be filed with the Division of Retirement. And then they, as long as they approve it by September 30th, then you get your state monies that year. So yes, you are correct on that.
All right. I just want to say as a board where we can help. And Jill, tell us if we're holding you up on anything from a reporting requirement, because we would like these funds, matching funds, or however you want to describe them, and not to miss that opportunity.
Yes, this is Jill. Every year, and I file the annual report we have between January and mid-March to get those reports in. The last piece of the report is the city's annual comprehensive report, and that is generally the last piece. And since that isn't necessary to have accomplished until June 30th, generally it is not ready till June 30th. There have been years where it's not ready till September 30th. And that's the only piece that usually holds up the money. Is if the city gets its annual audit completed in time.
Thank you.
Anything else?
Yes.
Is there a motion to accept Dr. Foster report?
Motion to accept the report is presented.
That's been moved and second that we accept the Foster and Foster report as presented. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries.
Excuse me, there's one more thing that I think Patrick needs to get for the state. A motion passed on the current rate of return. Is that correct, Patrick?
Yes, every year when you accept the valuation report, then you have to make another motion to declare that the board expects to earn 7.5% for the next year, the next several years, and the long term thereafter. We are seeing boards gradually reduce that assumption, and we may address that when we do the experience study. But for now, since that's the assumption we're using in the valuation report, that would be the appropriate motion by the board.
7%, right?
7.5%. Yes.
7.5. Yeah.
Okay.
Burgess, any comments on that?
Well, I would say this, based on the 10-year history and based on the asset allocation model, I would declare 7.5% expected return next year, over the next several years, and over the long term.
Okay. Is there a motion?
I motion that we stay with the 7.5%.
Is there a second? Second. It's been moved that we stay within the 7.5% assumption. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Okay. Let's see. Do we have anything else from this pension attorney?
Sure. So trustees, it's a pleasure to meet y'all. And I wanted to point out that I do not have anything for you to take action on, but I do have a couple quick reports or updates for you. So one update is the Florida legislature just finished their session in Tallahassee. And the good news is they have left pensions alone this year. So there was a lot going on in Tallahassee, which we don't have to get into, but none of it related to pensions. You know, there was an amendment to the Florida retirement system, which extended the drop for public safety officers who are state employees, but that doesn't relate to us because we're not the Florida retirement system. I'll also point out to you that the Florida retirement system goes through a process of what you just did of choosing what your investment return assumption is. And they decided, and when you circle back next year and get your experience study with Patrick, I don't want to read the tea leaves, but I have a feeling that Patrick's going to be telling you to continue lowering your investment return assumption. And that's exactly what the Florida retirement system did. They lowered from 7 to 6.8, and that's the trend that you're seeing across the state. And I'm showing a downward trend, meaning that plans, and it doesn't matter if you're a governmental plan or a private plan or a charitable endowment or charity, are all generally lowering their investment return assumptions. So that's a conversation that you'll have with Patrick going forward. But in terms of the legislature, they did not pass any laws that directly relate to pensions. I do want to mention that if we have some fairly new trustees, I just want to make sure that our administrator is checking with the trustees to make sure they do their Form 1 disclosure when they come in, and that any outgoing trustees are doing their Form 1F disclosure. That's always a helpful reminder. And I also want to point out to everybody that, it's towards the beginning of the year. We're still in March. So we encourage trustees, you're not obligated to avail yourself of educational opportunities, but by all means, there are conferences for the FPPTA and other organizations. So feel free to, attend those conferences, and, the dates can be made available if you don't have ready access to them. Our office, again, it's a pleasure working with everybody. And the last thing I'm going to point out is a little bit of trivia. So Patrick was telling everybody about the GASB 67, which stands for the Governmental Accounting Standards Board. And there was a big discussion with GASB, the finance folks, and I'm not sure if anyone in the room works in the finance department, but there was and we threw out the name earlier, that the city CAFR, which gets approved halfway through the year. So the city CAFR led to some controversy with names and nomenclature. And it turned out that that's actually CAFR. The way that we pronounce CAFR is a bad word in some Central African countries. So GASB studied this and decided that they're no longer going to call it the CAFR. So going forward, it's going to be called the AFR, which is the annual financial report instead of the comprehensive annual financial report. So that just gives you some new terminology. The ACFR, the AFCR is now the new term for what used to be called the CAFR. But unless there are any questions for the attorney, again, thank you for letting me fill in and attend remotely. And that will conclude the attorney's report unless you have any questions.
Okay. Is there a motion to approve the attorney's report?
I motion to approve the attorney's report.
Second.
It's been moved in second. Is there any discussion that we accept the attorney's report? All in favor?
Aye.
All opposed? Motion carries. Okay, first quarter expenditures.
There's one more item that Patrick needs to address, and that's their fee increases. It's on the agenda. His fee structure changes under 3C.
Okay. Item 3.
You should have an
3C.
actuarial letter in your packet.
Yeah, basically, for all of our clients, our expenses have increased lately, just like everybody else's. And we looked at all of our individual items, individual things that we work on, and we looked at how much it's costing us to produce. And so we're coming forward with some proposed changes. These changes wouldn't be effective until October 1, 2022. And so, the big report that I just did, the funding valuation, that has had an automatic increase in the past of 5%. And then everything else has been flat. And so the valuation costs $10,773 this year, and next year it'll be $11,312. Then but going forward, we would just tie all of these items to the inflation. And that way, it'll keep up, the costs will keep up with our costs. But then the electronic submission, we have to do that with the state. We're keeping that at $300. GASB 67 and 68. Our fee hasn't changed since it started in 2014. And so that's going from $1,250 to $1,600 and $2,000 to $2,500. Benefit calculations, we have one member do the calculation and another member check the calculation. And it takes us quite a bit of time. And so we're bumping that from $200 to $300. So you can see all of the different items that we work on in our new fees. And we feel like we're still very competitive. And, we really enjoy working with the board and have a long history. And we understand things such as the state monies and using them to provide additional multiplier. And the bottom one there, it says online portal if needed. I proposed that to you guys and I think you decided not to do it at this time. So that's just a fee in there if the board ends up deciding they want to do that. I'd be happy to answer any questions about this.
Questions? Is there a motion then to accept the new fee structure?
Quick question on per page costs, drop statements and COLAs. Approximately how many pages
Well,
are
that's
in
not
there?
per page, that's per person.
Per person? Okay.
So like
All
the
right.
drop statements right now, if we calculate their balance each quarter or once a year, and we charge $60 for each one. Now it would be $100 for each one.
Okay, I feel a lot better that that's not per page.
Okay, is there a motion to accept it? I'm sorry. Put your hand down. Go ahead.
So trustees, I always like to point out when a fee increases on the table that, the question sometimes comes up, what does the board have to do? And the answer is you have to pay reasonable fees. And if you're comfortable that these are reasonable, and in some cases they have not increased since 2007, right? And we're in an inflationary environment. If you think they're reasonable, then you should approve it. But you have the option to always do a RFP. You're never required to do an RFP. And I'll tell you, because we work with actuaries all around the country, that if you were to do an RFP, and your administrator might speak to this also, Foster and Foster, I have every confidence would be on the lower end, if not the lowest, in terms of when you look at that proposed fee of $11,000 to do the annual evaluation, for example. I have lots of plans that are paying multiples of that. And a lot of it's a function of how many employees there are, because the more employees, the more work the actuary has to do. But at the end of the day, the valuation that you're doing for a relatively modest sized city like Palatka is the same kind of work that's being done for a big state system. The only difference between your valuation at the end of the day and a big state plan is that they have more pages because they have more people, but the actuaries still have to do the same work. So again, the board has the opportunity. If you wanted to do an RFP, you could, but I'm telling you that I'm very comfortable that these fees are reasonable because we see all the actuaries across the state. And by the way, if you ever go to some of the conferences, you can kick the tires with other actuaries, even if you don't want to do an RFP, and they'll basically tell you that you're getting a good deal. So that's a little bit of behind the scenes overview of how the fees work. Unless there are any other questions, by all means, you can make a motion.
Are these the same fees for the other two pension boards in the city?
All of the fire board approved the new fees, and the general board, I guess, did. So all of the regular fees, benefit calculations, drop statements, COLAs, all those would be identical. The valuation report is based somewhat on the size, so that might be a little bit different.
Copy. Thank you.
Chair will entertain a motion to approve.
Make a motion to accept the proposed fee structure.
Is the second?
My second.
Is there any discussion? All in favor?
Aye.
Aye.
All opposed? Motion carries.
Well, thank you so much. I really do enjoy working with you guys and I appreciate it. Thank you.
You're welcome. Okay. First quarter expenditures. Should have them in front of you. Is there anything that's out of line?
If you notice, the Sawgrass, Burgess, and Capital City have budgets but do not have any actuals. Their bills came in after December 31st for that first quarter, so they're not recorded in this first quarter report.
Okay. We need to pay bills.
Well, we need to get invoices before we
Right.
can pay bills.
Right.
Yeah.
Right. So is this just on the agenda just to review of?
No, you do need to accept the
That's my
expenses.
point. We gotta pay bills.
Yes.
Because once you get the invoices, then you don't need to wait till the next meeting in order to pay the bills.
Right.
Is there a motion?
Our motion, we accept the first quarter expenditures.
Is there a second?
Second.
It's been moved and second that we pay the first quarter expenditures. Is there any discussion? All in favor?
Aye.
Aye.
All opposed? Motion carries. At this time, we're going to open the meeting up to public comments. Is there anybody online for public comments? Okay. Then while she's doing that, is there anybody present for public comments? With that, there are no public comments, so therefore we're going to close the public comments. Is there any other business that needs to be taken care of by this pension board? Is there a motion to adjourn? We stand adjourned.
Thanks, everybody.
Thank you.
Thank you.
you.
Good to talk to you.
Thank you.
Take care, folks. Bye-bye.
Right.
All right, bye-bye.
I'm out of this meeting, so.